Can options trading actually beat just buying and holding? To find out, I spent the last 30 days putting my real money on the line. The goal was simple: beat the S&P 500 and triple Q, while trying not to lose money, of course. In this video, I'll show you exactly how it went, the trades that nearly gave me a heart attack, and whether all the effort was actually worth it. But before that, full disclosure, this video is produced in collaboration with moomoo as part of an educational options challenge. But rest assured that all the views here are my own, and all the trades that you are about to see are real, including losses. Options trading is high risk, so please do your research, and of course, none of this is financial advice. And with that being said, let's not waste any time and let's jump right in. Now, if you have never touched options before, let me get you up to speed real quick so that you don't blur later on. So when it comes to option, there are two basic building blocks. A call means you expect the price to go up, or a put means you expect the price to go down. So simple. However, there's just one problem. In order to make money from buying call or put, I had to be right on both the direction and the timing, because if I got either one wrong, the option could expire worthless and I would lose all my money. So the way I like to trade options is to flip that around. Instead of buying the option and pray that the stock goes in the direction, I sell the option instead. That way, I don't need the stock to go the right way. I just pick a line, and whether the stock goes my way, goes nowhere, or even drifts a little against me, as long as the price doesn't cross my line, I win. And on top of that, I get paid a premium upfront. So that's nice. So with that, let's get started. For my first trade, I decided to go with cash secured put. Before I committed, moomoo's P&L curve showed me everything that I need to know, such as the break-even price, my max loss, my profits, and most importantly, the trade had an 87% chance of working out. I kind of liked those odds, so I sold it and collected $20 upfront. Then a few days later, the stock was still above my strike price. So I decided to just close it out early to lock in about $11 in profit, which is basically worth about 3 plates of chai fan with fish. And I was off to a good start. I was feeling good, so I did one more cash secured put on another stock, and ding, the trade worked out again, and I was up by another $14. However, by now, I felt that cash secured puts were a little too slow for me. Sure, they are lower risk and lets you buy the stock that you want, but the problem with them was that they tie up a big chunk of your cash as collateral for a pretty small premium. Take for example my very first trade. To sell that one contract, I had to lock out about $4,800 of my cash as collateral just to collect about $20. That's about 0.42% of return on the cash that I locked out. So I decided to up the stakes a little. Just to make things a little more interesting, I switched to something called a credit spread. A credit spread is similar to selling a put or a call to collect the premium. But instead of just selling that one leg, I also add another leg by buying a put or call further out. That extra leg will give me protection just in case the stock goes past my strike and the trade goes against me. And because my loss is now capped, the broker will tie up far less of my cash as collateral. Now, because this was a riskier strategy, I would also usually check moomoo's AI for a read first. On this one, for example, it told me that the stock was looking overbought and would more likely drift sideways or pull back than keep climbing. I had the same view, so I sold a cash credit spread, where I expected it wouldn't continue going any higher, and sure enough, it didn't, and I profited $21 from that. And over the next few days, I just kept running the same play. I pull up moomoo's AI for the read, sell the spread, collect the premium, then close it out a few days later for a profit, and it just kept working over and over and over again. Now, to be fair, a lot of that was due to luck, as the market just kept moving in my favor. But at the same time, what also helped was that I was disciplined about taking profits instead of getting greedy and holding for more. But then something happened. Right at the end of those first 2 weeks, one trade nearly gave me a heart attack. Like always, before I placed the trade, I checked moomoo's AI for a read on the stock. It showed that the stock was looking overbought with signals that it might trade sideways or pull back. Based on that, I figured that a call credit spread makes sense. So that's what I went with. But then, over the next few days, the price continued to climb closer and closer until it practically touched my strike. If it had kept climbing, I would have to take a loss. But then, right at the very end, it backed off. The options dropped to almost nothing. Henga. So I quickly closed it out to lock in another $69 worth of profits. By week 3, the market clearly wasn't cooling off. It just kept going higher and higher. Up until then, I will mostly be selling call credit spreads, where I'm expecting that the markets won't keep going up. So I decided I wasn't going to keep trading against the trend. Instead, I started opening put credit spreads, where I'm expecting the market to keep going up. And I wasn't just guessing the direction either. The other two I leaned on was moomoo's trend projection. Basically, it takes the current chart setup, matches it against thousands of similar setups from the past, and tells me how often the price went up from there. On this one, for example, it was showing a 60% chance of a move up the next day, with the closest historical matches over 88% similar. This was enough to confirm my bullish read and give me the confidence to put on the trade. Another tool that helped was moomoo's price calculator. With this tool, I could just enter where I thought the stock was heading and by when, and it would estimate what the option should be worth. This helped to make sure that I was actually getting paid enough for the risk that I was taking on, and not selling it for too cheap. And for a while, this would just keep working. I closed one put spread for about $16 profit, then another one for $22, then another for $35, and by then, I was feeling pretty good. But of course, the market always has a funny way of humbling you whenever you feel that way. It was week 3, and I had one of my smaller put spreads on. A few days in, it was already sitting nicely in the green, and I could have easily closed it for a small win. But I didn't, because I was waiting for a bigger profit. But then, the market suddenly started selling off, and I got some fabulous red light therapy. As it turns out, a really strong US job report had just came out. And while there's good news for the job market, there's terrible news for the stocks market. Because to the stocks market, a strong jobs report means that the Fed will have less reason to cut interest rates, and might even keep them high for longer, which makes it more expensive for companies to borrow, and that is bad for stocks. So all the big tech names suddenly jibaboom while dragging my stocks down with them. I watched my spread flip from green to red, and the loss was growing day by day. So in the end, I bought it back and locked in a loss of about $68, and I was actually lucky that I did, because right after that, the market just kept falling all the way down. If I had actually held on, I would have taken the full loss of $450 instead. So cutting it early was the right call. And this is also why you need to always have the discipline to cut your loss whenever you are trading, because it can help limit your losses before it snowballs into a much bigger problem. Though, funnily enough, the stock actually recovered the following week, but by then, my option had already expired. But cutting your losses isn't always the right move. Sometimes it's also the wrong one. So when week 4 came around, the same kind of thing happened again. I had a put credit spread on, the market sold off hard, and I was deep in the red. So instead of letting the loss snowball any further, I decided to just close my position and lock in a loss of about $150, which was sibei painful sia. And the moment I sold, the markets be like,
he sold from peak.
Now, you might think that the lesson here is to never panic sell, but it's actually the opposite. Sometimes cutting your losses will make you look like an idiot. You close the trade, the market turns around the very next day. But it's important that you stick to your plan and cut it anyway, because being a good trader isn't about getting it right every single trade. It's about being disciplined and sticking to your strategy, so that no single trade can ever take you out. So after a whole month of trading, here comes the big question. Did all of that actually beat just buying and holding? Here's the results. I made about $182 from my options trading. On my $5,000 capital, that comes out to 3.6% return. That means I actually beat both the S&P 500, which basically did nothing this month, and the QQQ, which only went up about 2.4%. Yay! So is buy and hold dead? Nah, of course not. For most people, the simplest and best strategy is to still buy and hold, and the data proves this. Over a long term, a simple buy and hold strategy has been found to beat 90% of active fund managers out there. So then, why do I still trade options at all? It was never about getting rich quick. Instead, it's about using your existing portfolio and cash holdings to generate slow and consistent income. And here's the thing, it was never about options versus buy and hold, because with options selling, you can actually do both at the same time. You keep buying and holding for the long term and sell options on the side to squeeze out some extra income, especially in those flat, boring months where just holding earns you nothing. Now, if you want to try out options yourself, Moomoo's got a few perks that can help you get started. If you are new to options on Moomoo and sign up through my link, you will get 0 commission on options for your first 6 months, plus a $10 trading cash coupon after making your first options trade to cut your costs even further. On top of that, you will also get up to $1,200 worth of sign-up rewards. And if you use my code Kelvin88, you will get an extra $100 worth of NVIDIA shares. Plus, you will also get 1 free copy of the options playbook after completing your trading task to help you pick your first strategy. For more details, do check out the link in the description below.